but I don't know if the chat is actually being recorded, but the screen is being recorded. Well, welcome everybody to the Lab to Market event today. Yeah, here we got some answers here. Nutrition recycling. Oh, there we go. To fertilizer, human urine to dry fertilizer. That's amazing. We need more of that. I can tell you, we really need fertilizers. It's got good business. I mean, I could even, like, as a part of helping society, I'd love to help you to get that thing up and running, because we need fertilizer. And yeah, but keep it coming. But I will start to introduce this thing. You have traffic management, optimizing signal timing by using connected vehicle data. All right, sounds cool as well. Yeah, that could be done. Every time I go up to traffic light, and I'm like, why are they designed like this? Because of the time of the day, they should adjust it. Or if it's like a weekend, like in the middle of the week, like it's a holiday, and they don't adjust for it, and the lights are not adjusted, it seems stupid. Cars are just moving inefficiently. And let's see, I could put the presenting mode there. And yeah, all right. But you keep writing. Here we go. Reti as well. Oh, yeah, she's writing here. Oh, nice to have you. Reti is also handling the tech for today, so hope everything runs smoothly. All right, but let's. I will start the slideshow here. It's gonna be very short, but it helps to keep everything in order. Here we go. So welcome everybody to the Lab to Market. And today we're talking about attracting investors, which is a quite interesting topic, because if you want to spin off your technology at some point in your life, you will need money, because your technology is rarely at the point where it can be paid for by your customer, because it's advanced enough to leave the laboratory, but it's not advanced enough to really be sold directly to the customer. And that's where investors come in and help you to get things really going. Or even if you can sell something, it's not like you need help and you need money to pay salaries and get people involved who can do marketing and sales and other stuff for you that you might need. So that's what we will talk about today. I'm your host, Rasmus Basilier. I run the Euroscalers program, among other things. I help companies who are, let's say, in turnover between 50K to 3 million to improve their sales. But today I am working and as a host of this event. And what's going to happen today? We're going to have these guys. We're going to start today with Lauri, and Lauri will talk about how you use like the math and the logic of investments, how they make decisions, because they actually have a lot of options, and not everybody gets invested. So he will explain what is the logic behind who they pick and don't pick, and it's not so much emotions as it is like scientific thinking, I would say. Then we have Kalev coming in. He's from Super Angel, and he will talk about the role of market validation in making a choice of investment, which is also a really important part to complete the picture. And then lastly, we'll have a case. We'll have Paulus from Adamant Health, and he will explain how he has raised 3 million euros in the last 30 months. And he will explain how that works, what has been the trick for him. And yeah, this is the schedule. So we start with InVenture, and in every session we have Q&A. So if you have questions, just throw them in either in the chat or in the Q&A. I don't really care, but somewhere in there that I can read, and then we'll take them up in the Q&A section, which is in between each speaker. And sometimes if it's a really interesting question, I might interrupt the speaker and say that question, but just write it in there so we can have like a good interaction, because these guys are very clever, but just as anybody, they might forget something that's really cool to say, because so just ask the question. It makes it more interesting. And then yeah, I could just mention quickly, we have some opportunities here in I'm gonna move this to the other side. There we go. So Aalto Ventures Program have a couple of things. So they are doing education for you guys at Aalto, but of course if you're in another university, I think you can take these courses as well. So they have the venture program with impact research, where they help. This is a professional development training course for researchers that aim to impact as well, gain skills, resources, and career progression inside and outside of academia. So that's coming up. They have that. Then they have the Starting Up, which is a free open access online course. It covers the fundamentals of starting up. And then Impact Studio, which is an incubator that they run to help you through the steps to become some type of business, a scale up or something like this. And I think, Aro, if you can put these links in the chat, they can check them out as well. And VTT Launchpad, they are also sponsoring this. So they are helping you guys who are in VTT, who are listening here. You can access Launchpad in order to incubate and commercialize your service. So they help that by creating IPR or actual companies. It depends. And in the incubation program, the spin-off teams are supported to develop to fundable startups geared for international growth. So that's what we got going on. And Aalto Startup Center does similar things for Aalto that Launchpad does for VTT. So they help you they get advise you and support you in growing and making your research into a business. I mean, these are things we're talking about here in this event as well, but which speaks primarily about investors today. Okay, that was a little bit long. So I think, yeah, we get feedback later. I think it's time. It is time. Stop sharing. Okay, let's get the first guy on stage. Lauri Kokkila from InVenture. Can I get you up on stage? Yes, there we go.
Hello.
Nice to see you, Lauri. So he's from InVenture. They're a Nordic and Baltic focused fund. They invest between 300,000 to 4 million, quite a span. And he will today talk about the math and logic of investing. So, Lauri, take it away.
Thank you, Rasmus. Great to be here and see some of the familiar faces as well in the audience participant list. So I'll give you today kind of a quick overview of what we do at InVenture, but also a bit about why does market opportunity and the size of the opportunity is so important to investor, and walking you through the logic of how these VCs work and what's the power law that kind of powers them. Because I think that's fundamental for you to position your innovation towards investors. So just a couple of words about myself. Been with InVenture now 7 years, a partner in the fund, being part of quite a few investments, sit in 6 different boards. Biggest out of them company-wise is Swappy, that reached 200 million revenue last year. They do refurbished electronics. We're actively looking for new investments, especially in the areas mentioned on the right-hand side. At InVenture, we want to be your trusted early stage investor. We know that money is not the only bottleneck you have, so therefore we've doubled down on focusing on talent in hiring people to our company. So that's where we then more operationally also support the companies that we invest in. And we've built a framework on how to scale internationally, because that's what all large companies have to do. And we're very much focused on becoming the partner to build your next $1 billion company. And why I'm talking about the billion, not the million, I'll describe soon. We've been around the block quite a while, have done more than 80 investments, of which majority are here with logos below. Volt, Swappy are the consumer-facing ones that many of you know, and depending a bit what area your research is, you might know the other logos as well on the below. A lot of spin-offs from VTT, from other university-backed startups as well, as you can probably recognize from the logos below. We raised a new fund just this year, which is 150 million euro fund, where we invest, as Rasmus mentioned, between 300,000 to 4 million as initial investment, and then we can follow on the future funding rounds. When the companies need more capital, we can then follow up to 20 million over the lifetime. So it's really can be a long-term partnership with the startups that we invest in. That's briefly about us, but how we evaluate startups when we meet them regularly. This year we've actually crossed that 2,000 already, so we've looked at 2,500 companies in total this year. We've done 13 investments, which is a bit more. Is more than we typically do. So typically we would do around 10 and looked at 2,000, but it's been a fairly busy year for us. And the number one thing that I think people often don't understand is is why we look at large market potential and what's the fundamental of that. And especially when you're in research and you try to think of positioning your company, that you make it big enough an opportunity and you're brave enough to tackle a big opportunity. That's why I wanted to focus on the market potential today. And the reason why that market size and market potential is so important is because of the logic on how VC funds work. And VCs are the main source of financing for startups still today. To understand the logic and where the money is coming from, so we gather the money to our funds from different institutional investors and family offices that commit to the fund, and we then draw the money to our account when we need that to invest to startups. So let's say we raise now 150 million from some of these people. This could be up to 100 even different institutions that we then get the commitments to our fund, and we then invest that further on to startups between a typical fund between 20 to 40 companies. And while these companies then exit, hopefully within a decent time frame, which often is 6 to 7 years, we get then returns from those exits, and then the exits are distributed further to LPs. And this cycle should go through in 10 years. So we should return the money to our investors within 10 year of time frame. And this is very typical standard within Europe. Often these funds go long though. First fund, we're still an investor, for instance, in Canatu, material innovation company. Although we invested, I think, back in early 2010s there. So we've gone above the 10-year life cycle. So that also happens sometimes, but still there's a time frame.
Can I ask you something?
Of course.
This goes a little bit fast here. So you have investors, you say you invest, but you have investors like, so what does the limited partners do? Like, who are they?
Yeah. So limited partners are pension funds, family offices, whoever who basically invests into venture capital funds. Yeah, your pension money, it can be a bank, it can be an insurance company, whoever basically holds money and wants to invest that through venture capital funds
so
like
you
ourselves.
have people who have money, but they don't give you all their money, give you like 100,000, 500,000, a million, and they put that like in a big bag of money, virtually speaking, and then you and your colleagues take care of that big sack of money and distribute it to different startups. And that's your job. Oh yeah. I just wanted to clarify this because when I was younger, I always found it really complicated. Maybe this helped a bit, but yeah. Sorry, Laura, keep going.
No. Thanks a lot for clarifying that. That's very important to understand. And these investors, these limited partners, LPs, expect a very high return because investing in venture capital historically has been a very risky investment. Because we invest in these new technology companies, it's one of the most riskiest assets out there. Therefore, they expect a high return for their investment, meaning 20+% yearly return rate. On the other hand, we know that when VCs invest into early stage companies, majority of those companies that we invest in don't really return well to the investors. So on the left hand side, you see the deals done in US companies, 85 between 14, and you see that 50% of those deals that the funds did returned less than one time the money back. So they were not profitable investments. But once you move up the ladder, you see that only 6% of the companies invested returned more than 10 times the money back. But out of the total returns, they represented the 60%. So this very rare part of the portfolio is actually what really makes the difference for these funds. And this is what we call the power law curve that that happens in other scientific areas as well. And that's how you often describe this kind of return profile of these investments. So that's how skewed it is. So this creates a funny situation where our investors are expecting a higher return of more than 20%, but we know that 50% of the companies that we invest in typically doesn't return money back to the investors. So this puts on a difficult pressure in trying to actually make profitable returns for our own investors. And therefore, this now links very closely to how big your idea should be, that it's interesting for a venture capital fund. So I'll run through you an example of a fund that is 100 million, and we expect to return that 3 times back to our own investors. And it's 3 times back because if we look at 20% year-on-year growth that I mentioned, and we put that for 6 years, it goes to 300 million roughly. And that's why we need to return at least 3 times the money back to our investors. A typical fund like this, as I said, invest between 20 to 100 companies. More typical is 20 to 40, I would say. So that's why I'm using 20 companies here as an example, marked with letters like this. So as I showed, historically, we know that 50% of these investments, no matter how good your and reputable your fund is, you will do the profile looks pretty much this in the kind of bottom end, that 50% of the companies will fail or return basically no money to you. So therefore, out of the 100 million, you lose between 20 and 50 million, depending on how much you've invested in this portion of the portfolio. Because of course you want to allocate most of the money of the best performing companies, but you basically lose money with half of your portfolio. Then let's say that to simplify this a bit, the next 25% roughly return 2 times the money back. So you return back to the fund 25 to 40 million out of this 25%. So out of the 75% of your portfolio, you basically returned nothing except the capital back to the fund. Therefore, this puts a lot of pressure that the best performing companies have to return at least 260 million back to the fund. And often it is even single companies. So basically A and B may be in this structure that would actually be able to return this, and the rest would be just supporting. So it could be that 200 million come from 2 or even 1 company out of this portfolio.
So like one or 2 companies should be able to deliver like 200 times what you guys invested. If you invest
Exactly.
$1 million, so that makes a calculation. So you're trying to get all of these, like say 30, 40 you have here, to they should potentially be able to give you 200 times back, but you just know most of them won't.
Exactly. So that's why if we look at in an exit situation, we are not going to own 100% of the company because the entrepreneurs are going to be still owning a lot of the big part of the business, and then there will be other investors that will join as well, and they want their share. So typically in an exit, we own 10% or sometimes even a lot less when the company is actually sold or goes to an IPO, or then some other investor buys our share, or even the entrepreneur buys back our share, whatever the way is that happens. This means that these companies in total have to be actually worth 2.6 billion in total, because we're going to only own 10% share on average out of these companies. So to put it in short, every single investment that we do should have a theoretical possibility to return at least 1 times the entire fund back. So let's say if you would have had a 50 million euro fund, your startup should have the opportunity to reach 500 million, because we would only 10% in that 10 years. So this means that every time when you approach an investor like a venture capital fund, your startup should basically have a potential of 10 times the fund size, and that never means less than 500 million. And there are not many markets and not many opportunities where you can actually look yourself in the mirror and say, there is an actual opportunity here to do something 500 million. A lot of the technology that you're building on, for sure, there's an opportunity like that. but you need to position it to a larger, big audience and find the business opportunity that's big enough for that technology. So often we see from companies coming out of the research that focus on a too narrow application that doesn't have a big enough market opportunity to be interesting for our type of
so if I can say, well,
investor.
look,
But
this is
that
going to be
can be
100
created.
million, you're like, yeah, but 100 million is not enough. Like we can't,
Yeah,
that's not interesting.
yeah, exactly. Or even worse, sometimes it's 10 million, and 10 million is not interesting yourself either. And knowing the risk profile of these entrepreneurs as well, I mean, if you go on this path, you should really try to capture the big opportunity rather than spending time on something incremental per se.
Thank you, Lauri. Like we're running out of time here. We have a couple
Yes,
of
that was
questions.
my last slide.
Yeah,
That was my
awesome,
last
awesome.
slide.
So he said, like, just make sure you get some back. Yeah, that's the risky investment. And question for Lauri: how to generalize the graph in slide 10 in your case? In a 16Z is a wild case of VC company, top 1% globally.
Yeah, so that data was not A16Z data. That data is all US venture funds that they gathered. So it wasn't only from that one simple company. There is, unfortunately, there isn't publicly available data from Europe enough to maybe draw a similar graph. But based on my experience on our funds, it's pretty similar. Of course, varies a bit, but the logic is very similar. That it's always our funds typically have 25 to 30 companies. Typically, 1 or 2 companies make the majority of the returns for that fund.
Yeah. Thank you. And then we have, in short, just build a company worth at least 2.6 billion. Yeah, that's easy. And
Exactly.
and Carmen says here, very useful. And that's something to notice that Lauri didn't really say it. He said it indirectly. It means that Lauri's fund, how was it now? Your fund is 150 million. So that means that Lauri have to find companies to return, the fund by X amount. So he is interested in a certain amount of a certain company. By Super Angel, their size of the fund is 50 million. So they will look at case. In case of Kalev, who will talk soon, he doesn't necessarily need to have as big of an upside as Lauri needs to have, because the fund size depends the type of company they're looking for.
Yeah.
All right. Okay, Lauri, thank you very much for the presentation. Thank you for sharing this basic math of making investments, and looking forward to seeing you guys in the discussion a little bit later today. Thank you, Lauri.
Thank you. Thanks.
Now let's get Kalev on stage. He is from Super Angel, and they invest between 100,000. Nice to see you. Between 100,000 and 1 million euros, and they primarily help the companies then grow in the next 18 months to really get them off the roll. And he'll talk about the role of market validation and maybe fill in some of the gaps that he might have found in Laura's presentation. So, Kalev, on stage. Nice to see you.
Thank you. Nice to be here, and thank you, Lauri, for making a good groundwork for what I'm going to be talking. And let me share the screen.
Great. There we go. It's loading.
All right. So I'm from Super Angel. I'm a coaching investor, and my role in Super Angel is to help portfolio startups to get unstuck and help them to get to the next level in 18 months, because in 18 months they have to raise the next round, and you have to be in good shape to raise it on a favorable terms. And so Super Angel is created by founders. So we know how freaking hard it is to build a startup. And that's why we do things slightly differently. By the way, on this picture, there's a Super Angel partner, Marco, who is doing a reverse pitch. It's a skydive pitch, but during skydiving, during a free fall, he pitches Super Angel to founders. You can check it out in YouTube. Here is maybe most important stuff about the Super Angel is that we invest in this region. We invest into B2B software and software-enabled hardware startups. So unfortunately, we don't do material science investments yet, but we are interested in biotech and space tech. So we are educating ourselves, and probably in 2 years, we actually might invest into these fields. And as Lauri mentioned, that every fund has to offer something in addition to money. And as Super Angel founders, the philosophy has always been that they want to build a fund they never had when they fundraised it from investors. So we go an extra mile and do a few things differently. First, that we believe that the founders of the startups have to grow faster than their startup as a leader and as a person. Second, we believe that you have to establish good habits from early on. And the 3 good habits that we believe are the key is goal setting and KPIs and measurement. Second is setting a culture of accountability in your team if your team grows. And third is offering unrefusable offers to your customer. It's always a moving target, and this is what we're going to talk about today also. And so the first two, the grow faster than your startup, set good habits, and the third thing is asking for help is a superpower for startups. And I don't know about you, but what we found that Estonians, at least, are very bad at asking for help, and especially bad when they have to pay for our help. So we have figured out a way how to help the startups to hire visiting chief marketing officers, visiting chief financial officers, and so forth. People come in for 2 months and build your business infrastructure, like your sales playbook, automate your emails, or set up your KPI dashboard, or automate your sales funnels, and so forth. So this is what we do, and we have Super Angel partners have 4 unicorns to prove that they have a good hunch on finding great startups. And so what I was asked to talk about is that when Lauri told you that how big companies we want to see to be built, that is there ambition, is there potential to build like 1 billion euro company. And as Lauri mentioned, it's true that to tell you inside ourselves that Super Angel is a smaller fund, and for us the valuation of 200 million makes it already interesting investment for us in early stage. So how much of customer validation you need to have in order to build this let's say roughly company with a revenue of 100 mil. The question is that why do you need to get your idea to market fast? That venture capital is very, very unique way of funding your company or getting your idea funded. So it doesn't suit everybody. There's a very specific set of companies it works well, as you heard from Lauri, that these are the main reasons. And yeah, I have another graph of the same power law. And, basically, 0.1% of startups bring back 97% of exit profits. And so the guy who makes the most money, it has to bring money back like at least 140 times. And it has to do it in short period of time, because investment funds usually have investment period is like 4 to 5 years, and after 10 or 12 years they have to exit. So they have to sell all their ownership if the companies haven't gone to stock market or exited through sales. So investors can't wait more than 12 years or 10 or 12 years. So we have to get the investment back fast. And I'm going to show you a graph that why this growing 10x growth, that in first year you have 1 million customers, in second year 10 million, then 100 million, and so forth. That growth is 10x in 5 years. That it's not only good for investors, it's also good for you under one condition. And so here's a graph why it's good for you, because if you can grow your company in 10x speed, then in order to get at the end of the third year to 10 million euros, which is like a starting position where you can start to scale to 100 million euros of revenue, in the first year, you need only 42 customers. If you would grow in 3x growth, you would need already 400 customers in the first year. So from a startup point, if you can figure out how to grow 10 year by year, then it gives you longer period of time to learn and figure out who are the customers who really want your product and are super happy for your product. Is it physically possible? Has anybody done it actually, this 10x growth? In software world, yes. Probably the most known name for me, at least here, is Salesforce. Now, a question is that you are scientists, that most of you don't build software. What's the different expectation from investors compared regular software startup and deep tech startup? So the difference is that, as you can see in the graph, that we understand that in the beginning there's R&D phase, which is mostly funded by public sector, like university grants, research grants, and so forth. But we still need that damn growth. That when you go to market, there's slightly more time to kind of establish yourself, but then the growth has still been fast. So there's not much not much time is given for deep tech startups. There's a year or so, but you have to start growing fast, equally fast as with software companies. And there is not much statistics about deep tech investing, but software as a service, it's a SaaS here. The software as a service funding, you can add up some numbers here or some percentages, but basically in deep tech, it's quite similar. It's not like 10 times the money. That if deep tech needs more money, then investors are willing to pull 10 times more than into software companies. Usually it doesn't happen. The market averages are pretty much the same. That if you want to raise like 6 to 18 million euros, then you need at least annual revenue 500,000 to 2.5 mil. So really big money comes with actual revenue, which is kind of bad thing for deep tech, because really costly stuff is to build it. So how can you convince investors that your idea, your breakthrough is worth investing? I think that the key concept here is to understand that investors don't invest into technology. It's sad but true. Investors don't invest into technology. We invest into business models. We invest into market opportunities, that there's a big problem, somebody has to solve it, and does this technology have a potential to solve it, and can this team build it into growing company? That is this business model going to make money and grow fast? So let's take a practical example. That if you seem to have so Lightcode Photonics, it's a super angel portfolio startup. When I first met the founder, Heli, in Tartu, our partners had already met them like 3 months before, and it wasn't sure, is it the startup or is it a research project? So the founders were not very clear themselves also, that is it something they should quit their academy for, or is just a nicer research idea and there is no business behind it. But basically, light code photonics is a new way of building 3D cameras for service robots. So basically, they change a way how robots see us. And there's a very clever photonics breakthrough, what they use. And there's a hardware component, but the main thing is software. That smart calculations and the way how they interpret the light, and they compete with 2D cameras, lidars, and yeah, basically these are the main competitors. So when I met them, in the picture you see a vision that it's going to be a size of a soapbox or like a phone. And actually, the bigger vision is that it's going to be a size of a chip, and it can go into your smartphone. So, but when I met them, the size of a product was the size of a table. You needed 4 people to lift it. So that was a first prototype of a camera, and there was no way you could attach it to any robot, even like big ones. So it wasn't working prototype in terms of minimum viable product you could offer to customers. So I met with Heli, and we started to talk about what kind of business opportunities they see there. And so they mapped me these possibilities, that the elephant selling this stuff for expensive licenses and expensive hardware, it's autonomous car companies like Tesla and these guys. They would buy this camera to improve improve a 3D understanding of locations and moving objects around the car. And at the B level, you're selling chip size, you're selling chips for putting them into mobile phones. And the other applications are in between. So this is one very good way of starting to think that how many customers do you need in order to make it to $100 million or euro company. So, and they, with that discussion, we said that, okay, they could offer this product to any type of level, that they can do bee level, they can do elephant level, they can do rabbits, they can do mice, they can do deers. So which customer segment is the best? And we started to talk about the pain, that which customers have mosquito bite problem, that it hurts, but you scratch it and that's it. You don't buy a product to get over the itching of your mosquito bite, usually. Or do you have a product for shark bite problem? If shark has bitten off my leg, I don't scratch, I need help. I need some kind of doctor, I need some kind of product, I need some kind of medicine to fix me. So I can't wait. I'm willing to pay whatever it takes to get my leg back on. So are you solving a mosquito bite problem or a shark bite problem? And so here are 6 criteria to kind of measure that how big problem I'm solving with my technology. And I put bold the frequency. The more frequent the problem, the better for you. Even if it's not so big, but more frequent, it's better. And another important aspect in terms of, in addition to the problem size or problem pain size, is your market demand capture or demand generation? Meaning, are people Googling about your product already, which demand capture, that you can put yourself up and say, hey guys, I'm a better product to your alternatives, buy me. Or it's demand generation. Nobody Googles you. Nobody is searching for your solution. And you have to start to educate that the solution exists and they have a possibility to do something. So the more you are in kind of demand capture, that people are already searching for some kind of alternatives and there are crappy alternatives out there in the market, better for you.
I think, Kalle, we got to go close to rounding off because
Okay.
we're even past the Q&A time.
Okay.
And we do have a question. You want to say some finishing words before we do one question and go over to the next
So
speaker?
my finishing word was that what I did was that what all good scientists know how to do is gather good data. So I suggested to Heli that go and talk with 5 customers, and I gave her this book, the Mom Test book. So you should read like 2 first chapters of it. Rest are not so important. And what happened was that she gave back with really good data on what's the customer actual pain points and problems, and they identified on a market the right size of a customer they can serve. And it ended up that by talking with the customers, they shortened their product development by 12 months, and they got the investment from us and the other investors. And they are now in a process of raising the next round. So I can share the slides also. I have go through that. Basically, there are some more guidelines on how to
there's more to do there.
good data.
Yeah, but talking with the customer is super important, and I think you will enjoy your research more when you know that what the customer kind of gets out of it or could get out of it, than if you just do it what you think that is good for you, and that enables it to be investable when you know what the customer needs. So we have a question here: what stage is it good to apply for angel investors and VC? They kind of combined it now. Is it essential to have a minimal viable product, or maybe idea market validation?
If you have some kind of idea market validation and proof that you can build it, like in case of light code photonics, they had a kind of working proof of concept prototype that it proved that this science breakthrough what they made, that it's possible that you can measure it. And now it was our belief that can we believe that they can shrink it from a table size to like a bigger box size and then to the soapbox size. This was the risk what we took. And can this team build it and sell it? So the biggest in science, the biggest is can this team sell it? And in their case, with the reading the Mom Test book and doing by the book, going out there and talking with the customers, it proved to us that they can do it.
Very nice, thank you. The best hires an answer, he said, after traction, when you should do something when somebody's interested in buying what you have, or at least signing up for a waiting list or something. I think I agree to that. If you can show that people like, whenever you're ready, I want to buy. If you have a list of those people, that's very practical, because that means for Kalle, otherwise he has to kind of guess. But if you have a list of people ready to buy, then he can like, okay, well, at least these guys want to buy. Yeah.
The last thing at conditional contract. If there's one key word you take away from this is conditional contract. Basically, you agree with a customer that you start to serve them with a product or service in 10 months from now. And you agree, you have a contract where if you can do it, they're going to send you this amount of money to that bank account. And your product has to deliver these features. And if you can't after 10 months, then it's postponed for 6 months. And if you still can't, then the contract is cancelled. You can't do conditional contracts in all markets, but you definitely should try. If you can pull it off, it's much easier from the investor side to invest in you. Letters of intent only mean that you have met the person. Doesn't mean anything regarding are they buying it or not.
So it's true. That's a very good last point. Thank you, Kalle, very much for coming in, and thank you for sharing your perspective. And I can answer this question: why would a company agree to conditional contract? It's because they could have preferential treatment. Let's say you have a machine that makes soap or something, and I say I have invented something that makes the machine go 10 times faster, but it's not ready yet. So if you sign the contract with me, you'll get it first. And that's like, if it's really good, if it's a shark bite problem like you talked about, you'll be happy to sign that contract because you don't pay anything if nothing is delivered. So it's a win-win. Can you recommend an angel who would be interested in have experience in digital healthcare? Well, you can. Maybe you guys can answer this in the chat, you investors here, to share your experience to Jana here. Okay, now let's go to the last one. We have Paulus from Adamant Health. Nice to see you, Paulus.
Hello, nice to see you all.
And he is going to tell us a story how he has been raising 3 million euros over the last 30 months to this day. And maybe he had even more in previous companies, but let's talk about the last one with Adamant Health. Adamant Health, you do very like the latest, was it the 3rd generation tracking of Parkinson's symptoms, which is more advanced than anybody has been able to do before. But Carlos, give me a quick intro. Who are you and what is Adamant Health? And then we'll take it from there.
Yeah. So I have a 28 years of high tech, a long history with Nokia, almost 80 years, and then 10 plus years in startups, 4th startup ongoing. But the first one I have been really part of the founding team, but the second health tech startup. So Adamant Health is a health tech startup, but also a deep tech startup. So Adamant Health's story as such, as a company, started 2020 in August. So we are like 2.5 years roughly old. But being a deep tech means that actually the work for the company was started 15 years before that at the University of Eastern Finland. So Sara Rissanen, the other co-founder, she has been working on developing a method how to measure and identify symptoms of people with movement disorders like Parkinson's disease. And so she has been working on that very long. And then around 2017, in the group, they decided that they want to bring this innovation and technology not only into scientific articles and so forth, but into the hands and for the benefit of patients and the doctors. And so they applied for, at the time, a research to business in Business Finland, or TEKES, what it was back then. And then during that process, they worked on kind of the business model and kind of what kind of product this would be, and they at that time already kind of thought, okay, this should be a service and provided for healthcare providers. Then the way I joined this was the Corona spring. I was kind of looking for a new project, and then through Aalto Ventures, kind of I was talking to Inga Mero, and she was saying that okay, she has this kind of interesting project ongoing in Kuopio, but they will not they cannot kind of look at it if there isn't a kind of someone who has been bringing technology into market, so productizing and doing some commercial side of bringing technologies into market. So that's how they introduced me to Sara, and Sara had seen Aalto Ventures kind of already a year or year and a half, 2 years before in a pitching event for early deep tech startups or technologies projects, and that's where they started the discussion, like two years before the first investment. And then Voima followed Sara's work, and then kind of introduced and networked me with Sara, and then we started to talk on Teams, of course, because of the pandemic. And Sara is based in Kuopio, I'm in Helsinki. So, but then we started to work on that and came to a conclusion that what she has been doing and what I have done in my past kind of matches and the kind of interest for making this forward. So then we established the company and started to look for money.
There we go. Well, thank you for that intro, Paulus. But like we just saw that they had in InVenture 2,000 pitches to them per year, and they picked 20 or 30. So they pick like 1%. So, and I've heard there's a lot of research going on, and they try to commercialize, it goes nowhere. So what is that you're doing now that makes you go from like, you come in, what are the steps that you take now to be investable as a idea? Yeah.
So I think kind of many of the things that has been said kind of before by Laura and Kalev is exactly so. But I think the question is really about the story, about the team and the story. So what you are doing and turning that So it's not about, like I said, it's not about the technology. It's about kind of what you can do. So what is that you try to solve with that technology, and then kind of make that so understandable that people who don't understand Parkinson's in details still can understand, okay, so why this is relevant, why this is new, why this is kind of difficult to copy, and then to understand that okay, so Parkinson's, well, you maybe didn't know that it's the fastest growing neurological disorder in the world, from 10 million to 25 million patients in a couple of decades. It's something which is very costly. 1 million patients in US, the healthcare cost is $52 billion per year. So then when you start to put these figures in there, it starts to kind of look the curve that you can turn into. If you're successful in certain time, you can turn it into $1 billion business per year, and then it kind of starts to make sense for the exit opportunity. That okay, somebody would actually come and buy with a significant amount the company, and then there would be the opportunity for the high kind of return for the investment. So kind of all these things, bits and pieces, need to be there. But then the other part is that, and that I think that's the key, that for the research, out of the research, we had the prototype, we had the algorithms, so we had the clinical evidence for healthcare technology. You need that. So kind of we did not start the company in the middle of the research phase, but rather the research was done, the prototype was done, it was clinically shown that it works. So where we started was actually to productize it, to make it a medical device, to have those things that are needed to enter the market and really start to work on that.
And I think you said something in the beginning, and I wanted you guys to mention that they started already 2 years before you, like openly discussing with investors and like trying to go to pitch events and stuff like this. Because there's something that the investors do, they didn't say that, but this is my opinion, but I believe they do this. They benchmark when they meet you the first time. They benchmark, okay, that's where you're at. And every time they hear about you from that point, you have to improve. And if you do that, they'll start to the blip on their radar become stronger and stronger. And then when you are ready, that now the research is ready, we want to take in investment. Those guys, like Warma Ventures in your case, they were like, okay, well, are you guys ready now? Because like we've seen you grow for like 2 years and it looks potent. Like then they're ready to put in the money way faster. Because otherwise, the fastest in like. You can write in the chat if you disagree, Mr. Investors here, but the investment speed is roughly half a year to a year. So there are fast investments happening in like 3 months, but usually there's a courting period that I need to get to know you, what's going on, and I need to see that even if I do nothing as an investor, you still survive. I don't care if you're dirt poor, if you're losing money. They don't care. They want to see that you keep growing, you keep evolving and building this business without any help from them in at least 6 months, and they're like, okay, all right, I see that you're making it. Now they're willing to put in, possibly putting in some money. So in Paolo's case, that you didn't have to do that because you came in slightly later, but the groundwork these researchers did, like those of you here who are listening who feel like researchers not as much as business people, like Paolo's might be represented, even though I think you got some research background in a way as well. You're quite a clever guy, but that you can start talking with investors even though before you can get invested. They kind of like to know what's going on anyway.
Yeah.
Yeah.
And I think kind of that's where there is a kind of a quite big difference in terms of that when you're talking about deep tech and health tech and kind of these difficult kind of things. So then the investment cycle is exactly like you said, and kind of in our case as well, that you start early, you talk, then you find those VCs who are actually kind of interested on the idea, even though you are still in the research side and in the university side and so forth. And then they follow you, and you keep kind of communicating with them. And then in our case, even though when I came on board, or kind of in June we started the discussion, but the pre-seed funding of 500,000 we got in end of November. So it took still like 6 months to work to get the first money. And then, of course, we had to go for the soft money as well with the Business Finland and ELY-keskus and so forth to get kind of that happened. And of course, kind of when, even though we were talking about kind of Voima, but then it was that, okay, but you need to get also some angels, so some others who will see the opportunity as well. And so we had to build the kind of the investment pool where there was the Voima and then others.
Yeah.
And then with that, we planned that, okay, that should be kind of from roughly 18 months or so to get a point where we would be ready then actually for the seed round. And we were targeting to have the seed round kind of then originally end of 21, but actually we got it in May 22. So then again, it went like 6 months long. And again, it comes back to this surviving game that you need to be capable of running the thing kind of much longer than you expected. But then we got the first part of the seed round, and now we are running with that, and the target is somewhere in 24. But we are still looking for roughly 1 million of that seed round we are having. So the kind of money hunt continues.
The Innoventure and Super Engine. Wink, wink. Like,
Yeah.
it's still like that. I mean, maybe you're outside of the fund size, the ticket size at the moment. We got some quick questions here for you, Paolo. So, did you already have a patent for the technology before you achieved funding?
So we have applications. So the patent processes are so long that they don't. Those were done as part of the research to business kind of phase. So they are still in the process.
Patents pending, but the products that you have are kind of protected. They're difficult to copy, and yeah.
And that is kind of the of course the patents are important, and you need to start consider that early on when you are kind of doing the innovation and working on that to protect it, and especially of course with the academic side, then kind of to understand what is then the kind of published articles versus then the patents and so forth. So it's kind of a tricky field.
Yeah, you have to be smart when you do this, that if you do research and if you publish it, it's not patentable because you published it for free, like for everybody. So you have to, when you're looking at, oh shit, this is tech we could actually do something with. There are smart people around like Paulus and others who can tell you how do you go about this process. But you got to be careful. You can't just publish everything you find if there's a business potential, because the patent will be unavailable. Let's go to the next question. How long did it take to understand your research market potential and form a business plan before acquiring funding?
Well, that was kind of our process again. So during that kind of research to business phase, there was the kind of first iteration, and then we continued to build that. But then it comes back to then kind of to really understand the focus that what the technology could be used for. So, for example, on movement disorders, there is kind of tens of different conditions. We chose Parkinson's. We chose Parkinson's because everybody knows what Parkinson's is roughly. It has a kind of significant kind of size in terms of a condition, so it's not that rare, but it is kind of significant in terms of people, in terms of healthcare costs, and so forth. But then kind of on the other hand, we know that for every Parkinson patient, there are 40 other movement disorder patients. And then kind of you can build the business case so that kind of now we go for Parkinson's, and then we can extend within Parkinson's and then outside other conditions as well. And that kind of has a two kind of points. One, which is for the startups, that still be clear on what you are targeting to. So don't just try to solve all the problems and saying that, okay, this is a technology which can solve anything, because then it starts to be a solution looking for a problem. But rather kind of then select the one that you really are going to put your efforts on, because even though it's kind of a one problem, there's a kind of lots of work to be done to solve that. And then kind of you may have the opportunity that, okay, so when we are there, then there are other things you can go to when you have
you
when you
Parkinson's
are
first
ready
and
for
then the
that.
other ones.
Yeah.
And I can mention this is not famous to you, but it's like the word business plan. It almost makes no sense. I would maybe use the word like business hypothesis, and it's a working hypothesis. So you mean you can make a plan in like 1 or 2 hours. Well, what do we have? What are the options? We think it might be Parkinson, it might be cerebral paralysis, it might be a couple options. We got to check these things out and see what makes sense. Okay, we come back. Okay, it seems like Parkinson is growing the most. It has the highest, it's costs a lot of money and we can measure it well. Okay, well then Parkinson probably it is. And then you take like you just move with the business, and then you try to validate it by checking with Parkinson's doctors and other like who's paying for this, who has and patients who have this problem, and trying to figure out is the Parkinson's the way that's the one that this is really useful for. And every day you try that more and more, and eventually you see, yeah, it seems to be like we were like it seems to be Parkinson is the one the customers like, the patients can use it, the doctors like it, we get the clinical data on it, and the market is growing. Okay, now let's go with Parkinson's. But it's like a hypothesis that's developing as you're building the product. You don't like make a business plan. So I don't even know if we talk with Paulus again in half a year, whatever his business plan was now is probably going to be different in 6 months.
Yeah.
So
and that is kind of one of the things which we never made. Well, actually, so I came after the research business project was over. So then they made a business plan with a consultant for that, but we have never kind of updated that as such. So what we have done is we have our materials for kind of pitch materials and so forth, and calculations, and we update those, but we haven't created a new 20-page Word document kind of writing all this, because it's a lot of time and nobody really have time for that. So you need to be clear and understanding of what you are doing, what is the opportunity, but keep the format something that is easy to read and it's easy to maintain and update.
Yeah. Thank you, Paulus. Thank you, Themis, for all the questions, because you kept this alive. So I think that's it for you, Paulus. Thank you very much for coming in. Thank you for sharing your experience, and best of luck in raising that next million.
Thank you.
Thank you. And maybe I should have helping Parkinson patients. Maybe that's what we should focus on. So let's look at that. All right. We will thank you, Paulus. We will in a sec go to the tables. But before that, I would just like you to quickly do this feedback form, please. You can just use this on your phone. You just take up your phone, scan this using your camera, because I think most cameras, Android or iPhone, has an automatic QR scanner in the camera. So please just fill this feedback form quickly. And then while you're doing that, we will very soon go back to the tables. And in the tables, you'll be able to meet with the guys who are speaking today, and me as well, if you want to talk with me. But primarily the investors and Paulus will be there to say hello. And I can do this like a little bit larger screen for you, so you can see it like this. And what else? Yeah. Oh, so even the link in the chat. Look at that. Amazing. Both Rete and Aalto made it. So now you have that as well, so you can do it in the chat. And remember, we have Aalto Venture Program had the impact with the research that you have opportunity. You can also do the starting up thingy and the impact studio. See what I should be able to say that again. So the impact with research is development training for researchers. So you can get to the point where you're able to do more impact, commercialize your research somehow. The starting up is a open access online course covering the fundamentals of startup entrepreneurship. And impact studio is an incubator which takes you through the steps to verify where your idea has potential or not, and that's offered by Aalto Venture Program. VTT also helps you incubate and create your startup, or make your IPR commercialized through inside of VTT, and Aalto Startup Center does a similar thing for Aalto. It also works with people who don't necessarily have deep tech when it comes to Aalto Startup Center. So if you're entrepreneurially inclined and want to see what's going on, you should check out these depending on where you study or work. Okay, that's that. I think Reti, you want to take over? Yeah, there we go. Hello.
Hello, and thank you everyone for very cool keynotes. Yes, so Ventures program, you can definitely try out these practical skills that you learn from lab to market sessions. As mentioned before, we have offerings for startup accelerator, impact studio, which self-driven, And additionally, you can take some entrepreneurial courses to practice your skills on a higher level. So definitely check out the links that we shared in the chat. Yes, but now we would like to move on to the networking session. So everyone, I will turn off the presentation mode, and then you can go and join the rooms with the speakers by double clicking on a chair that you would like to sit on. And then you can already talk to speakers. Please move to the rooms that have your dedicated name on them. Yes, but thank you.
Thank you, Reti. And I'd love to connect on LinkedIn. Please check me out, Rasmus Basilier on LinkedIn, and it's in the chat.
Yes, great. Okay, I'll turn off the presentation mode now.